In this video, guys, I'm going to talk about, are you really mentally prepared for the inevitable drawdown that your trading system has? Stay tuned. Hey traders, warm welcome to you. Thank you for joining me. All right, so every single trading system out there will have a drawdown. Even if you are trading a kind of a variation of different strategies, you put them all together, you're trading in some way, you will have some drawdown. And very often, when traders come into this period of drawdown, we feel very despondent, very upset, very frustrated, very angry about our performance, and our confidence takes a knock, and we wonder what's gone wrong, and we see our account equity curve go lower, and we want to get it back to highs, so we end up revenge trading. We end up doing all these kind of things that we know don't serve us for a long-term trading success. But what I want to kind of point out in this video, guys, is to say, listen, a good tactic is to think about and expect this X to happen so that when it comes, you're not caught out. So what do I mean by this? So let's say you're trading a kind of regular trading strategy, and let's assume, just for argument's sake, you're going to be right 50% of the time. And let's say you've had a good run and all of a sudden you're right, seems like it's right 70% of the time. So you've got a really good run in a week, in the last couple of weeks, and long term, you're expecting 50-50, but your risk reward ratio is 3-to-1, so that's going to work out in the wash. You're going to become profitable using that strategy. But let's just say over the 2-week period, you've maybe had 2 losing days. So it's statistically out of what you'd expect. But that is, when you think about your coin toss, guys, I've done a video about coin toss before, that's 50-50, but you're going to get runs of heads, you're going to get runs of tails, and sometimes you get quite long runs of heads, sometimes you get quite a lot just from the way the statistics work. But if you do it over 10,000 tosses, it's going to be as close to 50-50 as near, and the more you do, the more close to 50-50 it's going to be. So you may have a scenario where you've had 2 weeks, you've had a couple of losing days. Your equity curve is at highs, you're very happy, those losing days came maybe in the middle of both weeks, bang, your equity highs, great, doing well. Now, the expectation you have is that, hey, I'm doing really, really well, I've had a good run, look at my account balance, it's at highs, I'm going to continue. Now, for you to imagine you still had the 50% kind of win rate, if you like, you are going to be in a situation where you may well have another 2 weeks where you have more losing days than winning days. And if you stuck to it and assuming your risk reward ratio is high, that's still going to be okay for you, because over the 4-week period, assume it's 50-50, but the risk reward ratio gives you the profit. But you may get into a situation where you see that drawdown and you start to feel despondent about it, and you start to think that it's something to do with your trading. You start to see your account equity curve lower. The difference is the way you frame what you see. So none of us particularly like to see, no, listen, let me reframe that and rephrase that, should I say. We all like to see our account balance at highs. It's human nature, right? We like to see that, it makes us feel good. But we also need to be at peace and comfortable with a drawdown in equity to a certain extent. So we need to understand that this is part of the process. And the way we do this is we say to ourselves, okay, I'm risking X pounds per day, X dollars per day. If I have 5 losing days in a row, which, bearing in mind I've had whatever it was, 10 in a row and 2 losers, let's say I could easily have 5 losing days in a row, my maximum risk on the day is, let's say, £1,000 for argument's sake. That's a £5 grand drawdown over a 1-week working week period. Am I comfortable with that? And this is where you put your frame in you kind of flip your mind and go, right, my account equity curve is at X, minus 5k brings me to X. How does that make me feel? And if it makes you feel uncomfortable and anxious and the negative emotions that we feel as traders, you need to think about the size you're trading and the strategy you're trading. And you're almost not accepting the reality of the trading system you're using. Now, I know it's easier said than done to label a system and go, it's got an X% win rate, X% profitability, and I get the real world trading is not like that, especially if you're not using an algo. And if you are using an algo, you can have out of measurement statistics, if you like. There's a correct word for it. You guys are going to probably correct me in the comments section below. But a statistical anomaly, if you like, of data that comes in clusters and shows different to what you're expecting. So that's trading. That's real world thing, real world kind of P&L. But the key to kind of not letting that bother you, if you like, is to accept the fact that you could have that drawdown. Accept the fact that if you had 5 losing days in a row, a grand loss per day, 5k, accepting how would you feel if it was that. And if you know that that's going to make you feel very, very bad, it's going to make you want to chase stuff, it's going to make you want to revenge trade, it's going to trigger all the negative emotions that we know once we get into that, we've got not a hope in hell of success if we continue to do that. So we need to then reverse engineer that and go back and go, right, well, I don't really want to have that. I'm not comfortable with that. What am I comfortable with? 3k, 2k, whatever it is. Okay, well, if that's the case, I need to adjust my strategy. I can't blindly trade my strategy and only look at the good side of it without expecting to have some of the drawdown with it. And that's what I think many traders we find ourselves doing. We look at the good stuff, we don't expect the bad stuff, but the bad stuff is just normal. That's the key. It's not even a bad trade, it's just in the statistical relevance of it. So we're not even looking at an anomaly where you go, oh, I've had a couple of bad weeks. We're saying a bad week after a good run. But because you've had the good run, because you've done this, you don't like to see this. It's like when you could say you're in a stock, and I think a lot of the Bitcoin guys were like that. They're in it, ripped up, it came back down. Now, when it was $100, if you said it was going to 10 grand, where it's approximately now, they'd be over the moon. But the fact it's gone to 20 and come to 10 has kind of cleared many people out because they've not wanted to see that drawdown. So the same with your equity curve. If it's spiking up based on a very, very good win rate and then it's coming back, that's still normal. And the average, a moving average of it should be where you're kind of concentrating your efforts. But the key, going back to it without going off topic here, is that you look and you understand what the drawdown could do, how it could affect your P&L and how you would react to it. And if it's too much, then back off the throttle. There's no problem in backing off the position size and the frequency of trading to be able to come to a point where you go, you know what, if I have 5 losing days in a row, I can stomach a 2 grand loss. I can stomach a 20 grand loss, a $200 loss. Whatever order of magnitude it is for you is irrelevant. I can stomach that and I'm happy with that. Because the problem we have is when we have a normal occurrence of trades, we have the drawdown, we don't like it, then on week 3 we're trading on tilt, we're trading out of revenge, we're trading this, we're trading that, we're breaking rules because we have triggered something in ourselves, the pullback from those equity highs. So it's worth thinking about, guys, it's worth thinking about where your equity curve could be under normal conditions. You know, what wouldn't be a surprise if it was there? And then seeing if you accept it. And if you accept it, that's fine. But if you think that would trigger something, maybe now is the time to kind of back off a little bit and trade a little bit smaller size, maybe adjust the strategy you're trading, maybe become a little bit more cautious about what you're taking, whatever. But however you do it is basically preparing you for that time when you might have 5 losers in a row, 5 losing days in a row. You might even have 10. We haven't even talked about having 10. You might just have 5, keeping it in the normal statistical variance of statistical distribution, if you like, of trades. And that would be normal. But if it's going to tweak your emotions, it's worth doing something about it now, because too many times we see that drawdown and it triggers negative emotions in us. So have a think about that, guys. Let me know your thoughts on that in the comment section below. A bit of a different topic, but something to consider, because I know many of you are having great runs in trading. You're doing very, very well. You're really maximizing your returns. But it's just something to be aware of. The drawdown is fine. We want to minimize it, but it doesn't trigger a kind of drawdown that just ends up spiraling into and undoing all that good work. So take care. I'll see you in the next one. Keep your risk managed. Bye-bye.